Can I please ask our moderator and panelists of the last panel of the day, the future of the ecosystem. The moderator is Moritz Schuh of the Austrian Blockchain Center. We've got Cantwell of Cosimo. And now, do we have Maurice? We have Maurice. Maurice is coming. Maurice Tracey, business operations at Defactor. We've got Brian Elders once more back, the founder of Source Digital Assets, and Brian Haynes, Assetera and ex-CEO of BAWAG. Before you guys start, I was asked to tell you that there are very, very few seats left for the brunch tomorrow. So whoever would like to come, visit the page of LinkedIn or Twitter of the Munich Security Token Conference, sign up and grab the last seat. And I'm handing over to you, Moritz. Thank you.
Thank you, David. Thank you, everyone, also for your participation in our first Munich Security Token Conference. I have the honor now to moderate our last and probably broadest panel for today. With years of experience in banking, venture capital, blockchain, and DeFi, our panelists will now take a look at technological innovations in finance and the possibilities of a decentralized digital ecosystem. I would also ask, if you have any questions, you are invited to raise them already during the discussion. And before we start, would you please introduce yourselves? Let's start with Byron.
Sure. My name is Byron Haynes. I'm the co-founder of Assetera. My fellow co-founder is in the audience, Thomas Laudenbacher. Assetera is an EU-regulated investment firm license, regulated by the FMA. We've heard a lot about regulation this morning in Austria. And my daytime job, it's a secondary market exchange. And of course, we're very much looking forward to applying for the DLT regime license, which we'll do March next year. That is my part-time job. My daytime job is a banker. I've been doing that for the last 20 years. I'm currently chairman of a large systemic bank in Portugal. Previously, I've been a CEO of a similarly large bank, both regulated by the ECB in Austria, and I've also worked for other global banks prior to that. Thank you.
Maurice Tracey from Defactor. We are a B2B funding platform in DeFi space. We do that by providing collateralized funding, and we achieve that by bringing real-world assets by minting those and bringing those onto smart contracts and onto the blockchain. So we fully leverage the technology, the ability that it has to bring us to give us the quality of performance that we want, and we actually want to leverage that to give our community greater power within the economic flows. Let's say we finance 3 assets at the moment: receivables, trade finance, and inventory finance. So we stay very much in the TradFi space in terms of the asset class. People are aware of that. We risk assess it, we package it, and then we offer that out then to investors who want to participate in the funding process to give the liquidity to the platform. There's like a couple of people here. I'm an ex-banker or a current banker. I don't know how you want to describe us, yeah. I'm a late convert to the space, been on the project for about a year. Spent many, many years running businesses across Europe for a couple of banks, mainly in the cash flow finance area. So obviously, I think that was a great feeder for me coming into this space, because cash flow is like an intangible. You can play with it, you can cut it up, you can move it around. So when you come into this space and you're dealing with tokenization, it gives you that flexibility as well, and that intangibility to actually be creative in terms of how you want to structure deals, make something interesting, make it exciting. And I think that is one of the reasons why I came into this space in the first place.
I didn't introduce myself earlier, so Brian Elders with Source Digital Assets. We are founded in Hong Kong a while ago, and we're based in Ireland and Hong Kong, and we're a VASP in Ireland. So the idea of Source Digital Assets was that the world of assets is changing very broadly. So everything from securities to art and everything in between. So the idea was to help assist and build tools for those who wish to participate in those markets. So we work with Black Manta, who I'm also with, and we have been we have advised and founded a number of NFT and DeFi platforms over the years, so we're kind of involved across the whole tokenization spectrum. So times are interesting.
So Connor Cantwell, I'm with Cosimo Ventures, founded 8 years ago, based in Dublin and Boston in the US. 4 partners set up the business. Prior to setting it up, we had built and sold 13 companies between us before Cosimo. Cosimo is involved in right across the ecosystem. We have a venture fund called Cosimo X. It's a tokenized venture fund. It's a security token. And we invest through that into early stage blockchain Web3 crypto companies. We have a second fund called Cosimo Y. We were feeling very creative. And that is a risk managed fund, income fund that stakes some of the leading cryptos, and there's hedging on the other side. That's targeting the wealth management and pension industry, primarily in the US, and giving them product to provide to their customers. We're also involved we have another staking business, a node operations business, and actually together with Brian, we were bored one day and we co-founded a custodian, which is based in Ireland as well. So a custodian for crypto assets.
Thank you. So I will just start with Byron again, sorry. So in our first panel, we heard that tech should not lead but follow. So I want to ask you, which sources for innovation do you identify or see then outside of tech or outside of a company or companies that could take this lead in innovation or take this lead?
I've been slightly surprised by the level of discussion, debate today. I mean, this is the sort of first conference that I've come in this space, because there was a bit of it this afternoon, but for me, innovation should be driven by the customer or the client, be it institutional, be it investment companies, be it corporates, be it SMEs, be it high worth individuals. And there really was not a focus at all in innovation. There was a lot of innovation out there, majority of which I didn't understand, by the way. But the reality is, it's the customer that derives and should be the key to innovation. It's the customer demand, it's the customer wishes that will actually dictate, in my view, what the innovation should be and how that should go. It's the customer that is in the center of this ecosystem, and everybody else is in and around that. Be it the tech companies, be it the regulators and bodies, be it prime market, secondary market, tokenizations, and all the rest of it. And the way I see it is that innovation, the customer, the client, determines the what. And we had a number of discussions during the course of today and say, what is the cost of an STO? I mean, the reality is that the customer demand is so wide. I mean, the reality is it's very different from a startup to KKR. We had 2 examples today. We had a startup and a KKR situation. So for me, the client determines the what. What assets and securities tokenize? What markets are attractive? Where they're to scale? What technologies, emerging technologies, should be used to solve problems? What token assets require direct access? What financial services require direct access, etc. Where we play a role is what I would call on the classic supply side of the equation. In terms of education, we've heard that a number of times. You won't believe how little bankers know about this space. I'll come back to the banking bashing later on, which I'm sure you'll get an opportunity to do. But bankers don't understand this space. But what clients understand is they want to have a product, a service, which is safe, secure, efficient. Blockchain delivers that, compliant and regulated. Mm-hmm. Full stop. And I'm sure I'm crossing a few bridges here, but they've got no interest per se in blockchain technology. They've got no interest per se in innovation tools and how that operates, etc. But what we're incumbent to do is the education aspect, why it is important that we have X and Y. And the way I look at it is, take KKR, if I understand correctly from the lady that was on the, from Securitize that was on the panel, that they had some specific requirements, and Securitize then said, okay, this is what we need to do, this is what we need to adjust, et cetera, to create liquidity for that particular fund, in terms of making sure, I guess, there was no calls and these type of things. So that's the way I look at that. I want to, if you like, end on a quote, because the reality is you have clients that are early adopters to this, typically the younger generation, et cetera. There are, in my view, adopters that will come quickly is the professional markets. And ultimately, all clients, whatever aspect they're in that stream, want to have access to financial and capital markets. They want to have access to financial products and services that, again, the same things that are safe, secure, that are efficient or delivered efficiently, that are compliant and are regulated. I saw a quote from Gary Gessler, the chairman of the Stock Exchange Commission in the US, I think it was on Monday. And he basically said, most crypto tokens are securities. Securities are covered by securities law, and that the key role that the capital markets and regulation provide now and going forward will help solve and what's happening in this ecosystem.
Thank you.
Yeah. Can I just
comment?
I think your comment around tech-led versus customer-led is very, very relevant for this industry. So last year, I think we did 24 investments into early stage companies, and typically what you see is a bunch of technologists building technology. They hopefully get the tech built, but many of them run into a brick wall when it comes to generating revenue, selling. And that's a big challenge, I think, for many of the new projects going forward. And looking at the next couple of years and how we look at projects, can they sell? They can probably build the tech, but can they sell? Are they really building something and solving a real problem that the customer needs?
Yeah, I think I would add to that point in the sense that obviously coming to the space quite late, and I'm not from a tech background, I was very strongly struck by obviously the engineering focus and tech focus within the actual project. So therefore, I mean, that's understandable when you're at a certain point in phase. So within our project, we've gone through that phase where we build proprietary tech. We have everything in place right now to actually operate, and actually we are operating. And we've just done our first transactions on next generation smart contracts, and everything has worked fine. So we're proving the concept, let's say. But the challenge for us then, of course, is to try and meet the customer need in terms of how to leverage that, monetize that. So obviously we feel that we're in a very strong position because we're able to have big demand on one side from the body of people who are outside the banking system because they can't get credit that they need on financing of assets. Not that they're bad customers or bad assets. It's just that the banking system, as we know it, is becoming more and more constrained. It's shrinking in size in terms of its scope and its ability to actually trade, capital constraints, compliance constraints. So banking is getting more narrowly defined, which is leaving places behind on the pitch for others to fill, and that's the space we're trying to get to. But what we're trying to do is we're trying to release the economic value that people have in those assets to actually create value for themselves and create a value for the society, let's say. So in that sense, I agree with the comments that have been made. I think in our situation, we're more customer facing than many projects. So I think in that sense, we're in a nicer position that we can actually have that direct interaction and deliver that value, which I think is...
One of the key differences, though, is that Defactor, if I understand it correctly, was founded by guys from inside the industry who understood the problem, and they were building inside out rather than a bunch of technologists thinking great thoughts in a dark corner.
There's still a few techies in there.
You need one or two.
Yeah, I mean, Brian, maybe I ask you. So Maurice mentioned like DeFi protocols and how they try to tap into like traditional money, but what are pathways which are needed for traditional money to arrive in this space?
That's a debate that I've had with a number of people in this room, many lawyers, looked at many things that are available online and had them, depending on which country the lawyers from, criticize it or praise it. So you have at the moment a mishmash of different routes and ways into DeFi, and quite a lot of that is unpalatable or unsuitable for many, we'll call it traditional investors. So I think part of the challenge that we have is how to bridge between that DeFi sort of space and the traditional investor. And I think we're at the beginning of experimentation and the bringing out of some products to address that, because I think we may have different iterations in the future, but I think at the beginning, in order to get the traditional investment space in, you need to give them a product they understand through a way that they understand, and then have that introduced into the DeFi protocol in whichever way is suitable and proper, in order that the yield be earned. So I think we're at the very beginning of that. There's many kind of solutions out there, everything from just hooking in your MetaMask wallet and getting going through other solutions that involve full KYC. So I think that when we conquer that bridge, it will be a profitable bridge to own.
I think one of the things that surprised us when we launched our security token, I would say 80% plus of the investors are from the traditional side of the house, not so much from the crypto side. And the average age of, we have retail investors, we have family offices, we have university endowments, so a full spectrum. But of the retail investors, I would say the average age is about 55. And that we were really surprised by that. People are investing through their pension funds, they just want exposure, and what they want is liquidity in particular.
But I think that's also to do with commercialization. So yes, very successful, but because you had a business plan there that makes sense, it was commercial, etc. And again, what we've had today is a lack of commercial focus, a lack of, we can digitalize, tokenize, and so many different ways of assets and securities and stuff. But does it actually make commercial sense for the customer, etc. And clearly, and for the investor, because obviously they need to get a return, they need to make sense, and these type of things. And I think that's what's really missing out of this debate, is how you commercialize. When you're trying to use innovation to fix a problem, like lack of liquidity in the secondary market exchange or whatever, you actually have to have the commercial business case for it to make it work as well.
And the commercial needs to kind of chime with what people are familiar with.
Yeah.
Yeah, there's no point in having a super product that people can't use.
Yeah.
Maybe all our friends are over 55.
I make it.
Maurice, I mean, you are working in the DeFi space and your company develops DeFi products. So what do you think about this customer demand, and also what role does user experience and also interface play when you develop your products at Defactor?
Yeah, so I think obviously it's fundamental, because on one side we have demand from asset originators who are not in short supply, because there's lots of people out there. I mean, if you look at the data, 40% or thereabouts of all SME mid-corps that go to a bank for credit are not getting the credit approved, for various reasons. So there's a huge potential pool of people there who want value and releasing value of assets that they actually have. So of the 330 million SMEs in the global economy, I mean, that's a huge quantum of people. So in that sense, there's no shortage of that demand. The question is how to satisfy it and how to extract it. So I think what we have done with the tech that we have done and the way we do it, I think actually allows us to do that. But it does more than that as well, because if obviously we're now staying in the safe asset space, because obviously we're trying to get more adoption, mass adoption. But I mean, we have done proof of concepts on other assets. So we have done fine art, art collections, Can that be somehow tokenized, and how can you use that in some way in a secondary market or not? We've done a very good Irish one, which is a whiskey, a warehouse full of whiskey, because our whiskey has to sit there for 10 or 20 years. So how do I monetize that asset, And we've looked at gold as being a precious metal. Yeah. So the power, I think, of the tokenization for me, as I said, is the flexibility that it actually brings. That it actually then allows you, in a good, meaningful way, potentially to unlock all that value that in a traditional TradFi world is just really not available in any kind of regular basis. So therefore, it's value that's being lost. It's an opportunity cost to the global economy. So if you can actually get into that space and you can get into proper cash flow based structures, well, then you're unlocking that. And I think that's where you actually meet customer demand on the AO side. And on the opposite side for the investors, obviously they want to see, what am I investing in? So in the platform we have developed, we've actually able to show and track the risk at the underlying asset level. So, and the tokenization allows us to do that, so that as an investor, you can have absolute certainty where the money goes, how it's being used, what's the maturity profile of the individual assets. So you can actually track that in real meaningful sense and be comfortable that what's actually there is tangible. It's got good quality risk, it's acceptable risk for you. It's not in any sectors that maybe you're not wanting to be in. And at the end of the day, you're getting a return that is above what you would normally get. And the mix and the cocktail is attractive for both sides, I think.
Maybe let's talk a bit, because we were talking, I think, in the break about trust and what role trust plays in innovation. And as we know, like, trust is the main topic for blockchain use cases since the beginning. So what's your take on that? So what is the role of trust when we talk about?
I think it plays a key role. Let me turn this the other way to say, what is the big advantage banks have? And the big advantage banks have, in my view, are effectively they own the customer, meaning that all those segments that we've talked about always have a banking relationship in some form or other. So they are fundamentally own the relationship. Two is they've had years of accountability, of strict regulation, etc. So although there's a lot of bank bashing out there, the trust factor is huge and significant. Mm-hmm. And if you take that to the other side, we've just had the latest fraud announced today on blockchain. And for most customers, unfortunately, we're all tarnished with the same brush. So it's hugely difficult to build that trust when you don't have that track record that a bank has, etc. Now, they can both coexist, because most banks don't try to bank all customers, all segments, all banking models. Actually, most banks now operate on different models, some sort of outsourcing capabilities, either product, process, technology, etc. So, and I'll come to that later on. Banks are not standing still. Yes, they've got this crisis, that crisis, yes, capital short and all the rest of it. But this is a big enough space to operate in. But the key issue, I think, that this ecosystem has is to divorce itself from the scandal of blockchain fraud, etc., to, let's say, security tokens, which is regulated and which is controlled, etc. But that will take time, because the client ultimately still continues to be owned, in my view, by a bank. We can always talk about our customers and stuff, but ultimately they're still going to have that banking relationship.
I think the trust thing that you're talking about when it comes to blockchain, and even the hack that happened today, that I don't know much about because I'm here, but there is problems in some of that space, and you're right, that tends to be the unregulated space. But I think, and you can have a big debate around that and the amount of innovation and everything that's happening. But if you look at what we're here today to talk about, which is security tokens, I think a lot of those issues disappear. Because if you're going to create a security on a blockchain, you have to adhere to certain rules.
That's why I say education is key, because I can guarantee if I ask 10 people, very senior bankers and all the rest of it, they will point to what happened this morning or whatever it happened, etc.
Precisely, and that cannot happen with a properly designed security token.
Exactly, and that's why I think this space has such a high potential, not only for this ecosystem, but actually for banks, because their clients will want to exercise this capability, be it capital raise, liquidity raise.
Yeah, but you know, I wonder how many fines banks pay every year, what that amounts to. It's a hell of a lot of money. And in terms of, you know, a lot of the bank business models they're starting to date. They're carrying massive overhead. Yes, they have massive advantages, but I wonder, are they really leveraging those advantages? We've seen the likes of KKR investing into Securitize, or Aberdeen investing into Archax. So I suppose some of the financial services companies are dipping their toes in the water, because I guess they see the opportunity that exists. But you know, you go back this day last week, you know, and what the Bank of England we're looking at in terms of the pensions industry in the UK. You know, the systemic risk with even in all these well-regulated and very old institutions, but it doesn't take a lot for it to, you know, to topple over the edge. It's very fragile still.
But I think the point made on trust is well made, and I think you're correct. If you talk to your average person in a bank or wherever about a security token, their first thought, if they don't actually understand the space, is Bitcoin. And it's, you know, it is very far from Bitcoin, what we're talking about here, and the innovations we're talking about here are designed for, you know, completely different purpose. And that education piece is lacking, yeah. We're blessed with the Australian Blockchain Centre for some of this, yeah.
I think you have a couple of questions here.
Thank you. Talking about trust, and there's a lot of talk about central bank digital currencies, and let's say if the ECB rolls one out, how do you think will that affect the trust that, let's say, banks have or normal consumers have on the sector, and how is it going to impact your business models and how banks see STOs in this whole sphere?
Well, maybe I'll just start and a couple of quick comments and then hand over to people with more experience than me. Well, I think that a central bank digital currency from the ECB is completely different than something that may or may not be controlled by banks. And the CBDC might be too slow for some of the banks to move. So I'm very curious to see, will there be any brave European bank or American bank that will bring out its own Deutsche coin or something like this. But it's entirely possible. Banks already, especially in places like the UK or Hong Kong, they already print currency within, you know, the boundaries of the rules that are there for them. So banks are familiar with this. They might not be familiar with doing it on a blockchain, but they're familiar with the overall scheme of things. So I'd look at central bank digital currencies, and bank digital currencies slightly different that may run together, and will be private sector ones, I'm sure, as well, for whichever purpose. There's all sorts of these things already in existence to do with work dollars and all sorts of things in Australia and other places like that. So there's many, many different versions of it. So I think that they all come with their own risks and benefits, but we'll see probably all of them develop over the next couple of years.
Yeah, I would agree. I mean, I wouldn't necessarily comment on digital currencies, central banks, etc. In terms of private banks, I think, you know, that's not the first call. I think the first call really is on the security tokens, because security tokens, from a bank's perspective, is just like any other capital markets transaction. And I actually see a convergence between DeFi and central finance, etc. I think that it's not a choice. It's not an either or. There's a convergence, particularly helped as the regulators change, adapt, and adopt. I think it's a huge potential for a regulated DeFi, which we're not there yet, and I think a bank will jump on board, because for them it's not really such a big step, because they operate in a MiFID world. They operate on not all of them, but the ones that operate in the capital market space. So it's not a big jump for them to take on an STO. The big jump is really what happens behind that in terms of technology and innovation and all the rest of it. And banks are always looking at ways to cut costs and all the rest of it. I agree. There are banks out there that haven't been able to navigate all the crises. The financial crisis, the payments, the competition, the reducing fee pools, the increased regulation, the capital increases, and all the rest of it. But there are banks that are out there that have safely navigated that. So I'm not saying that all banks are going to go into the space and all banks will have the opportunity to go to the base. Those banks that haven't adopted, changed, particularly over the last 10 to 15 years, usually are no more. And those ones that are a bit more progressive and stuff, and they will enter this space. They are entering into this space. What you don't see is they're not going there with their hands up and etc. They're putting a huge amount of investment in place. Some are through partnerships, some are through own in-house projects, etc. Mm-hmm. So if you delve deeply, particularly some of the what I would call large US investment banks are really investing heavily into this space. And of course, when the regulation is caught up, I think you will suddenly see a huge competition in the marketplace.
Yeah, Fidelity announced a product this week.
Yeah.
I think with CBDCs, the benefits to the EU, to European countries or the US are marginal. The benefits to emerging markets or emerging market economies is way more significant. They have way more to gain. They can make a quantum leap in terms of their financial services infrastructure, by launching a CBDC. And that's, I think, the countries who are most advanced, the South Africas, the Malaysias, the Indonesias, etc. They're moving at a much faster pace. And one of the big questions, of course, around a CBDC is the extent to which it disintermediates, the commercial banking business in the economy. So where do you put your money? Do you put it into the central bank or do you put it into your local bank branch? So brings up some interesting questions.
I think in a capital markets context, I think there will be for sure more obvious benefits. I think that's, you can get into that scale effect and you can package things in certain ways. So I think I can see that benefit coming through very quickly in terms of the TradFi banks. But if you take it from a different perspective and you look at the particularly in retail commercial banking, which is fundamentally the backbone of the economies of the world, let's say, the cost base and the operational platforms that typically banks are operating off now are archaic, inflexible, and very expensive. And the error rate is very high, and the processing costs are coming down because there is investment going in there. It's not to say there isn't, but I believe that the level of investment, when you compare it to the blockchain smart contract benefits, is still huge. So one is very, very scalable. The others look like they're big, but they're not scalable because they just don't have capacity, in my experience. So I believe that until banks fundamentally redesign or scrap and start again their operating processes and whatever, they're always going to have an issue with processing costs that will actually constrain them. So I as an example, I ran a business which was processing basically invoices, 2 million invoices a year, so that's about 6,000 a day. So it's a lot of paper, maybe less paper now because there's obviously digital invoices coming through. But if you run off an error rate in terms of either processing and reconciliation error rate of about 10%, that's a lot of mistakes. It takes a lot of people to manually fix that. So if you can remove that away, apart from just your operating costing, then you're in a much better space. And the customer experience is much better. Going back to the point that the customer at the end of the day has to feel the tangible benefits from this in terms of what differences it make for me. Do I get more liquidity? Do I get more money? Does it happen faster, slicker? Is it cost effective? And at the end of the day, and I fully agree, I think trust is a fundamental virtue that we have to establish, because we need trust on both sides, from the asset originator side, but also from the liquidity provider side. There has to be trust that things are solid, things are work, and that it actually is good sense to do this.
Yeah, and what's interesting actually is in some of the projects that we invest in, many of the employees don't get paid in fiat, they get paid in crypto. And that's a big shift from where we are today, and maybe the trust that they have, maybe younger generations have, is in a very different place to some of us older guys.
It's very strong. It's quite bright. Should wear my sunglasses, right?
Just a really quick one. What is the feedback that you're getting from investors so far? As in the ones that have actually, accessed the exchanges and trading the security tokens. Are you receiving any definitive feedback, pros or cons?
Yeah, go ahead.
No, I can. For Assetera, we received our license at the end of February. We go live before the end of this year. Yeah, so that's where we are. So we get a lot of feedback to say that we need liquidity in the secondary market exchange, but at this stage, but we don't. We haven't got the feedback on the trading side.
Yeah, I think our experience is that many of the investors came into our fund to get exposure to the sector, so just a small part of their investment portfolio. Again, another thing that surprised us was that they don't want, most of them don't want to hold the tokens in their wallet, and we have a solution for that. But that surprised us, and for institutional investors, it creates another creates a governance issue for them internally in terms of how they're just not structured to hold them too easily. Now, again, more tools are becoming available to smooth that. But and the secondary market is one of the next big issues. There are new areas of liquidity out there. So you've securitized markets. You have Archax launching, I think, this month in London, again, targeting the institutional market. You've InvestorX, you have, one or two others. But the whole thing is very siloed. And I think Matthew earlier on mentioned interoperability, and that is absolutely critical for the success of security tokens. And, it's not a case of one player trying to build an empire. There needs to be an industry effort, a collective effort to remove some of those barriers and some of those silos.
I think I'd say that people who have actually purchased the security tokens and know what they're doing. Yeah. So far, I've only basically heard good feedback. The issue is finding more people that are willing to take that step. Yeah. And I think that's the bigger problem.
Yeah, and I think what we found is when you're selling to investors, you have to sell your product, but you also have to do the education piece. So you're nearly selling tokenization as well and the benefits of tokenization. But they get it. They get it.
There is no. Oh.
I don't have a question so much as an insight, maybe, because Byron was mentioning so much about the customer being at the center point. I fully resonate with that since I come from a strategy consulting background initially. However, having spent more than 1.5 years in this space, I can perhaps share what I have seen to be at the epicenter of this whole revolution. And it's not so much the customer as it is the community. The community is at the epicenter of this whole blockchain revolution, and that is something that is driving the whole decentralization. And that's why also we hear about DAOs. I've met some fantastic people who are part of DAOs, multiple DAOs, because they have shared purposes. They want to create change on a rudimentary level. And the tokenomics of it is just a byproduct to control the economic factors that come along with it, to have full control on that shared economy piece. And I just want to put this insight out there that maybe, at the end of the day, if perhaps banks want to really get into the space, we have to perhaps work on the community level and start looking at a collection of people who have a shared purpose. And this could be, say, a cooperative of real estate owners who want to tokenize their assets, because that brings in the trust aspect, that brings in the decentralization aspect. And I just wanted to put it out there. Because, if you also see the whole developer community in Web3, these are not people who've gotten any Harvard universities in computer science. These are self-taught, self-learned individual. 200 million, I think somebody was mentioning earlier, or 200,000, Solidity developers all over the world. They are all self-taught. And this is the power of this revolution right now. I think we need to understand it's the power of people with collective shared focus and shared purpose coming together to make a change. It doesn't seem like very much now, but till the time the next generation comes into the decision-making seat, I think we might see the locomotive pushing ahead with full force. Maybe right now it's going at a snail pace. So not so much a question, but just an insight. Thanks.
Certainly community is at the center. I think we heard earlier on from Joybroy that, you know, part of the rationale for them doing an STO was to embrace their community. So I think community, customer, absolutely, whichever way we describe it, having their engagement and support is critical. So I agree.
Questions? Yeah, that's right.
So when Michael was giving his keynote, he described the evolution from Web 1 to Web 3 as read, write, own. And spent more time talking about Web 1 and Web 3 and kind of skipped over Web 2. And there's nothing wrong with this characterization, but it's only one dimension. And I think from our industry's perspective, one of the things we really need to keep an eye on is the move from Web 1 to Web 2 was the move from decentralized HTTP servers to centralized platforms. And I feel like where we are right now is Web 3 is Web 1. And so thinking of innovation, the whole ethos of our system is to not build centralized platforms, but from a what do customers want? Nobody wants to run their own web server. Is there, from an innovation perspective, do we actually have to kind of undo the ethos and go the other direction? What is the direction of innovation in the STO space?
I think with real assets and regulated products, you're always going to have some sort of interface with centralization. It's how that's balanced and arranged is the question, and that's that's an open question.
If you go to a metaverse event, the hate that's out there for, let's not name any names, but some of the larger social media companies and some of the big players, and it's just the people involved in that business really just want to tear that whole thing down and decentralize it. But I'd agree with Brian. In STOs by their very nature means some level of centralization.
I think it's also related to the regulation. There's a discussion around, how you would regulate within the EU, because everybody's got their national, slightly different regulation in terms of the capital markets. But even if the EU could come up with an act or whatever it is, the reality is, you've lived with different regulation across US, Europe, Asia, etc. And I think that will coexist all the time. So in that sense, I never see a fully decentralized, capital markets. It will never happen. But what you all have is the pools of centralization in terms of capital markets in the different jurisdictions.
And if we did our STO 2.5 years ago, just in time for COVID, and it was hard because we were one of the first, we were in the first wave of STOs, and it was hard because everybody was learning. It's a lot easier now. And there have been so many innovations in that 2.5 year period that getting an STO out the door is, you can pull all the building blocks together depending on what you want to do. They're there, and it's a hell of a lot cheaper as well to do now than when we did it. We were very early at the time.
Any last questions from the audience? If that's not the case, then I would like to wrap up the panel. Thank our panelists and the audience.
And go for a beer.
Thank you.
Thank you very much.